Good evening, everybody, and welcome to the second in our series, ICE Futures Singapore, Trading in Cash-Settled Bakkt Bitcoin Futures. We have a good lineup for you tonight. We'd like you to settle in and listen to James Cox, who's going to discuss a little bit about the fundamental scenario after the halving, and also to Darren Chu, who will give you a little bit of an overview of the same, with perhaps a little bit of a different take on other fundamental factors. First, I'm going to give you a little bit of an overview on how ICE Singapore Bakkt cash-settled futures work. I'd like you to first take a quick look at the mission statement. And the bottom line is that we bring transparency, efficiency, and market access to participants around the globe. And the entire Bakkt initiative is around just that, bringing price transparency to the global Bitcoin market. ICE Singapore, where we trade the cash-settled BTC futures, was really built around the premise that we needed to address the retail market, and doing so on the same standard that we do for our institutional markets at ICE US and in ICE Europe. So we built ICE Singapore to lower the sort of barrier to access for retail and small speculators. No fees for market data. All of our futures are cash-settled. So whether you're trading mini Brent or mini dollar index or, of course, mini BTC, all the contracts are cash settled. Low exchange fees, and again, the same high quality infrastructure and matching engines that we have available in all of the exchanges in our ICE franchise. It's regulated regionally as an approved exchange and approved clearinghouse in Singapore by the MAS. And that's a theme we're going to come back to a few times tonight. The idea that we have end-to-end regulation on the trading of BTC, whether it is in the Bakkt warehouse in the United States for physical BTC, or it's in the trading environment here in Asia and ICE Singapore, or it's in the coming event of monetization of Bitcoin through our payments app that'll be launched later this year. One of the first things we wanted to address, and just to sort of give people a little bit of an update on Bitcoin as an asset class. There's been a lot of discussion lately amongst some of the big fund managers, whether it's Paul Tudor Jones or Rentech or some of the other hedge funds that are relatively new to the Bitcoin arena, but they're household names. They've been around forever trading other assets. And their new interest in the crypto world, and in specific in BTC and BTC futures, is really kind of putting things into context. What you see here before you is a chart that shows the annualized returns with a base of 100 at the beginning of 2017 and ending up here in actually in the second week of May 2020. The light blue line is the S&P 500, all by itself, just the straight up annualized return. The darker blue line is a portfolio mix of 98% S&P 500 and only 2% in Bitcoin. And you can see that they follow, of course, a similar trajectory with a reasonably high correlation over parts of that period. But overall, the returns have been much more favorable to a portfolio that's adopted a very small allocation of Bitcoin. And we'll talk a little bit more about correlations on the next slide. Sort of the foundation of portfolio management is this idea of finding anti-correlated or zero-correlated assets that enhance overall returns over an investment horizon. And so with this contract, taking a look at say, BTC correlations to the S&P 500, over that same period of time, we take a look at the fact that the net correlation, and this is using a 30-day rolling correlation, the upper chart, the net correlation on balance is pretty close to zero. It's plus and minus during different periods of the market in that time span. You'll notice that the two highest periods of correlation, especially here most recently in March, are with just general sell-offs, when all correlation sort of reverts to one when people are in a risk-off or risk-on mode. And you can see that the times of the lowest correlation are times when the market has been actually rallying, where Bitcoin has sort of outperformed. And going back to the previous chart, you'll see that same effect mirrored. You can see here in rallies, where the portfolio with 2% Bitcoin is outperformed. In sell-offs, the portfolio with Bitcoin has underperformed or performed pretty evenly with the unweighted portfolio that's purely S&P 500. So in the sell-offs, we see higher correlation, and in the rallies, we see a negative correlation. But on balance, throughout this period, it's pretty close to nets to zero. So it's not a bad asset to use in a diversification strategy. And that's been pointed out recently by a number of fund managers who are moving slowly but surely into Bitcoin as an alternative asset class. Okay, so why would you want to trade this with us? When you look at the regulated environment that is the ICE Singapore or ICE US, where we trade the Bakkt Bitcoin futures, ICE Singapore has a cash-settled contract that is directly linked to the price of Bitcoin via the deliverable contract in the United States. And what that means is basically we have, in the United States, we have a contract that is deliverable, and that contract at delivery becomes the benchmark price for Bitcoin. So if you settle the ICE Future Singapore contract to that, and without delivery, just cash net variation, then you can see that it's a fairly arbitrageable and very clean way to trade. We don't want you to take the risks that you don't want. So if you want risk exposure to the price fluctuations in BTC, the Singapore contract is great. If you don't want the risk of taking delivery, or you don't want it to run into operational risks around that, then again, the cash settled contract is probably the best way to go. It's traded via a normal futures account. And again, that should give a lot of people confidence in the idea that the futures brokers are regulated on their own through the same regulators that monitor the exchanges. So it's a second layer of regulation and investor protection. It's not available with a standard Bitcoin exchange. With a crypto exchange where you have a direct relationship with the exchange, it's different than the one where you have a relationship with your broker who in turn faces the exchange. It provides an extra layer of credit protection and an extra layer of protection from some of the other operational risks that we mentioned earlier. Again, the next point is we have the MAS regulatory oversight, overseeing not only the exchange, but the clearinghouse and the brokers as well. And we have what we believe to be superior security and technology infrastructure. We have a very, very large staff of people monitoring the activity on all of our global exchanges around the clock. Very fair to say that the security staff that we have in Atlanta monitoring the trading activity is larger than the entire staff of many crypto exchanges. So we have a very high focus on that, the same focus that we give to our other exchange environments. Just a really quick look at the difference, again, between the trading directly with a crypto exchange and trading on a regulated environment through a broker. You can see the three layers here. On the top layer, of course, is ICE Clear Singapore, which is our clearinghouse, working under the auspices of the MAS. The second layer is the protection that you're offered through working through a regulated broker, in this case regulated under the Securities and Futures Administration Act, the Securities and Futures Act in Singapore. And then if you look to the left, you can pick out two or three of these bullet points as being substantially different than what you see when you're working with just a standard crypto exchange, in that we have rigorous stress testing, which is again monitored by the regulator. We have very high standards in terms of our ability to monitor risk and margin collateral, again with the stress tested with the regulator. And then we have a seat at the table. We have our ability to contribute to product development and market development through our working directly with the regulator in shaping the way that the market moves forward. Just a quick look at the contract specs. As I said, they're cash-settled monthly futures. It's a 1 Bitcoin contract, and in just a moment when you see how that compares to some of the other contracts with a $2.50 per Bitcoin, or being equivalent to 1 cent on the contract. So it's a fairly small tick size when you compare it to other exchanges. Side-by-side comparison, and we just wanted to take a quick look at how it compares to the CME Bitcoin futures on the right. It's a larger contract. It is a 5-coin contract, which implies a $25 per tick, and it is settled against an index rather than directly against the price of a deliverable Bitcoin. So they use the prices from 5 unregulated exchanges to go ahead and determine the settlement price of their contract. There's some noise around that, as there is with any index contract, and it isn't a pure settlement price, a pure auditable settlement price, the way that the delivery of a single coin relating to a single price would be. So we prefer to set that standard the same way that we do for instance, cotton futures, or we do for futures on sugar. So the Bakkt warehouse concept was built around the same concept that we use for other commodities. The delivery of a real physical commodity is what should determine the forward price and the futures prices. And so we don't use indices in these cases. So it really is a way to sort of purify the process and make sure the pricing is completely transparent. That's been our approach to the market. Just one last look at the cost of trading. You'll notice that the bid and offer spreads are reasonably stable. This was taken on a delivery day. And if you look at the second month, which was the active month, of course, because first month is going into delivery, you can see that the spreads are pretty tight. If you look at BTM, which is the U.S. contract for ICE-backed Bitcoin futures, it was a $7.50 spread, so 3 ticks. In the CME, it was a 2-tick spread, which was $10 still because it's $5 each, and $5 per tick. And there's a 1-tick spread in ICE Singapore. Now, I would suggest that, if you can see how long and flat this line is, it looks like this pretty much throughout the entire trading day every day. And the spreads are sometimes favoring CME, sometimes favoring ICE US, and sometimes favoring ICE Singapore. But they very rarely move out of this narrow band that you can see up on top. So it's a reliable spread with a good two-way market. Just a quick look at the volumes since we started trading in the contracts. You can see the dark blue is ICE US, and that started trading in September of 2019, and it's had a pretty good run. It continues to build on stable volumes. We continue to get new participants into the market, 2 or 3 or 4 per week, that are adding to our stable of market makers and commercial users. And a lot of these users are commercial. They're actually using the contract to trade Bitcoin into the ICE US warehouse, the Bakkt US warehouse. The light blue line is ICE Singapore, and we're not ashamed of that volume either. It's very stable. We have a good crew of market makers that is trading the contract every day and keeping that spread tight. And you can see that overall, since launch, ICE US is about 65% of our total volume, with ICE Singapore being the other 35%. But now on a day-to-day volume throughout 2020, it's a little closer. It's about 60-40 in terms of market share between the two contracts. Anyway, that's about what I have for today. We hope you have a lot of questions for us and can help us out through your input at giving us a picture on how you'd like us to develop the contract. But right now, I want to introduce James Cox from Taipan Investments. James is going to give you a quick overview of the fundamental changes in the market since the halving and how we might see the market going forward in both a bullish and a bearish stance. James, over to you.
Thank you, Vince, for that excellent introduction. So again, my name is James Cox. I'm the CEO of Taipan Trading Investments. My fund is called the Straits Currency Fund. It's focused on cryptocurrencies and precious metals. This evening, I'd like to talk to you about the halving and its impact on the Bitcoin price. What is the halving? Well, Bitcoin miners offer computing power to verify transactions on the Bitcoin blockchain. The lottery system gives the successful miner a reward of new Bitcoins approximately every 10 minutes. Here we've got a picture of a Bitcoin farm. When was the halving? The Bitcoin reward halved on the 11th of May 2020, and this is part of an overall schedule that always reduces. The rewards happen every 10 minutes approximately, and from 2009 to 2012, there were 50 Bitcoins created and given to the miners every 10 minutes. This reduced to 25 in 2012, to 12.5 in 2016, and recently reduced to just over 6 Bitcoins per 10 minutes in May, and the next halving, approximately in 2024, will be just over 3. The significance of these halving will be discussed later in our show. First of all, I'd like to outline the bull case for the Bitcoin price over the coming years. I'd like to look at the big picture, the demand and supply of Bitcoin, stock-to-flow ratio, and some technical analysis. The big picture. In February 2009, Satoshi Nakamoto wrote, "The central bank must be trusted not to debase the currency, but the history of fiat currencies is full of breaches of that trust." And he wrote this as an explanation to the Bitcoin blockchain. Now, for those people who like to say things like we're keen on Bitcoin, on blockchain technology, but not on crypto, please remember that Satoshi Nakamoto is not so interested in blockchain technology, but rather the money itself. And we know that because next to the Genesis block, he wrote, "The Times, 3rd of January 2009, Chancellor on brink of the second bailout for the banks. The creation of Bitcoin was in part a protest against the inequalities and the unpredictability of the monetary system. It came out of the 2008-09 crisis, and here we've got a picture of the Washington Post stating that Bush called the bailout vital to the economy. And here in 2020, the Washington Post now tells us President Trump signed a $2 trillion economic stimulus. Again, the central bank can and will debase the currency supply if and when it feels required. But what does this look like in terms of a chart? Here we've got a picture of fiat USD in terms of base money, and we can see that in 2008, it went vertical, almost quadrupling over the next few years. Here we are in 2020, and we can see we're now in the midst of a financial crisis, and up goes the monetary supply in terms of base money in a vertical manner, and in order for history to repeat itself, the total amount of base money created is going to have to be approximately 10 trillion or even greater. Satoshi Nakamoto was very concerned about this and wished to create a type of money that had the absolute opposite type of supply. The opposite of exponential is asymptotic. And here we can see the amount of Bitcoins created halves every 4 years, and so it never quite reaches 21 million. In short then, ladies and gentlemen, what we have is a juxtaposition. A fiat currency which can be created to infinity, quite literally, and a hard, fixed monetary supply in terms of Bitcoin. We imagine then that people would rather swap their fiat currency for Bitcoin because they're swapping an unlimited and exponential money supply for a limited one. If that was the case, Bitcoin would go up in time, and we know this to be true. It would be great if it did so in some kind of predictable manner with some kind of calculation to help us have some forward guidance. Luckily, this is the case, and it's with a rather old metric called the stock-to-flow ratio. What does this mean? Stock is the amount of X type of money, and flow is the yearly new supply of X type of money. So if we use gold as an example, we know that the above ground stockpile of gold is approximately 185,000 tons, whereas the new supply from mining is approximately 3,000 tons, which gives us a stock-to-flow ratio of 62. And this is rather stable over time. It's difficult to greatly increase the amount of new gold that's mined. It's not easy to do. For Bitcoin, it's a little bit harder to calculate because at the beginning of the experiment, there was no flow, there was no stock. It was brand new in 2009. And so we know that it changes over time. Here we can see a graph of the stock-to-flow ratio of Bitcoin over time, measured on the right-hand axis and denoted in the light blue line. We can see that currently Bitcoin has a stock-to-flow ratio of just under 30. If we remember that gold is 62, we can see on this chart that at some point in 2022, Bitcoin's stock-to-flow ratio will be approximately that of gold's. However, by 2025, it should be over 100. This will be a very different type of money. We can also see in the dark blue line and measured on the left axis in a logarithmic manner the price of Bitcoin, and we can see that it seems to closely match the light blue line of stock to flow. As of right now, Bitcoin's price is slightly below 10,000, and that's exactly where it should be given this chart. Is this surprising? Well, no, not really, because we know that over time, the stock to flow ratio in the Bitcoin price has approximately a 90% correlation. So this seems to be a reasonably good indicator of where the price is heading in the future. We can also do some technical analysis. However, in order to do this, we need to use a logarithmic chart in order just as fitted on the screen. Here we can see a logarithmic curve progression with both an upper bound and a lower bound line, and we can see the peaks and the troughs just about touching both. We can see in the background, I've time sliced this graph so that we can see the reward rates halving over time every 10 minutes, from 50 to 25 to 12.5, and now to 6.25. We can see that there are cycles of Bitcoin spikes. And thanks to my colleague Marco Faas in Holland, he pointed out that there seems to be some kind of a relationship, and that relationship in terms of time just happens to be the golden ratio. The first spike-to-spike cycle took approximately 910 days, and the second one took 1,470, the ratio of which just happens to be 1.61, or in other words, the golden ratio. If we use this golden ratio to project into the future, we can see that we've got a much longer cycle expectation of 2,400 days. Is this a good thing or a bad thing? Well, it's a bad thing if you've just bought Bitcoin and you're hoping to see it go to the moon as soon as possible. However, if you have got a longer time horizon, you can view it as a good thing, because we can see that if this metric holds and the next spike for Bitcoin arrives in approximately May 2024, we could expect a price of approximately $250,000. This is, of course, not a guarantee that it will happen, merely a projection. We can also do some much more traditional technical analysis, and we can see that since 2018, Bitcoin has been in a mighty ascending triangle. And whilst I don't expect Bitcoin to break out of the resistance line anytime soon, if it does, I'll have to concede that the bear market is over and be a grudging buyer. I would expect Bitcoin to drop into the triangle for a little bit longer, but we can see that at some point over the next year, most likely this triangle will get broken, and if we're trend followers, we'll have to concede that it's most likely to break to the upside. And this fits in with our previous analysis. However, there is a bear case to be made. We'd like to look at the big picture, the concept of front-running, some Elliot wave theory, and some hyperwave theory. The big picture. Bitcoin has existed between 2009 and 2020, and this just happens to be the longest period of economic expansion ever recorded. However, as of March 2020, the world tumbled into a COVID crisis, and unemployment figures in the US and across the world rocketed sky high. How did Bitcoin hold up? Well, not so great. Bitcoin, as well as the other stock markets, all crashed. Now, will this correlation continue, or will it break down in the future? Many people say that Bitcoin is a non-correlated asset, and over a long enough period of time that appears to be true, but as of right now, it has done a reasonably good job, but not fantastic. If the economy tanks again, I expect Bitcoin to have a drawdown. Whether it's going to go very low, I'm not quite sure, but there are reasons to believe that it is possible. One concept I'd like to look at and highlight is that of front-running. For the first two Bitcoin halvings, Bitcoin went up before, during, and after the halving. However, on this third occasion, I would suggest that Bitcoin got front-run by professional speculators who saw the fundamentals shifting in the future and took action accordingly. And this is why we got a huge rally from May 2019 up until approximately July 2019, where the price went to almost $14,000. I would say that the price of and the fundamental factors of the halving was already baked into the price over a year ago. In terms of technical analysis, we can also look at Elliot wave theory, as created by Ralph Nelson Elliot. He wrote his 1938 book, The Wave Principle, in which he outlined that all markets move in a relatively regular manner, and that is 5 impulse waves that go upwards and 3 corrective waves that go downwards. I'd like to bring your attention to the corrective waves A, B, and C, and we can see that wave C goes below that of wave A. Now, this is significant because if we look again at the Bitcoin logarithmic regression, we can see that there were 5 impulse waves, 1, 2, 3, 4, 5, up until December 2017, and then a corrective wave A, an upward wave B, which is often referred to as a sucker's rally, and if wave C does its job and goes below wave A, that means that we're going to have a sub $3,000 Bitcoin and will also, perhaps more importantly, have broken the lower bound log regression. Now, this would be really quite unsettling for the market. However, Elliot waivers would argue that this is actually the perfect buying opportunity. Is this going to be the case? I'm not sure. I still imagine that we'll not go below $3,000. The idea is supported by a different type of wave, and that is Hyperwave. Perhaps less famous than Elliot wave, but still really quite interesting. It was developed by a man called Tyler Jenks, a trader who sadly died just last year. However, an excellent book was written by my good friend Leah Wald, who outlined his theory. Tyler Jenks used his theory of Hyperwave to trade sugar, silver, the NASDAQ, the S&P, and finally Bitcoin. In this theory, he outlines that markets tend to move in 7 waves if it's a hyperwave. Not all markets are hyperwave, not all rallies have to end like this. This is a rather unique situation. However, he outlined that there would be 4 upward phases, a 5th corrective phase downwards, a slight dead cat bounce called a 6th phase, and then a long drawn-out bleed, which is the 7th phase. He seems to believe that Bitcoin's hyperwave looked something like this, and he got involved in 2017 and made good profit. We can see here that if Bitcoin is a hyperwave, then it's a deformed hyperwave, which doesn't quite match. But this is often quite common. Tyler Jenks argued that phase 7 would be long and drawn out and perhaps go all the way down to $1,000. Is this likely to happen? In my opinion, not. However, Hyperwave, time and again, proved to be successful, and it's not something we should ignore lightly. In conclusion, probably, there is significant upside to Bitcoin over the coming years, especially when inflation takes hold, which I believe eventually it will when they print enough money. However, during the meantime, there is still price downside risk, as well as cyber, counterparty, and regulation risk. If you're new and unfamiliar with Bitcoin, I would suggest that the last 3 risks are much more significant than many people believe and tend to focus only on downside risk. How do we overcome these problems and try to mitigate these risks? In the short term, if you're a trader, I'd strongly recommend that you look at stop losses. This could save you a fortune. If you're thinking in terms of more of investment style, perhaps dollar cost average your position into Bitcoin over the months and years ahead. Alternatively, if you're a trend follower like me, you could wait for the trend to return by the trend lines or moving averages. In the long term, perhaps create some of your own upside price targets. You need to have a clear idea of when it is that you're going to get out. Secondly, perhaps look at some cold storage solutions. Leaving your Bitcoins on an exchange can be risky. And thirdly, perhaps look at some derivative contracts, such as the one offered by ICE. The reason being is that, in my opinion, ICE is unlikely to go bust like some of the other exchanges. They've got insurance, and also the cash-settled futures contract is very attractive from an operational risk point of view. That's all I have to say. I look forward to answering any questions that you may have in the future. Here are my contact details. Thank you so much. I'll hand you over now to Darren.
Thanks very much, James. And now we're joined by Darren Chu from Tradable Patterns. And Darren is going to talk to us a little bit more about the halving and some of the fundamentals, and again, a different view on technical analysis. Darren, over to you.
Thanks, Vince. Hi, everybody. Hope everyone's doing very well this evening or morning or afternoon, depending on where everyone's located. I have a wonderful set of ideas I'd like to share today. I think it's a very exciting time with Bitcoin. We've already heard quite a bit about the halving, and I'll jump right into it in a moment. Just want to quickly introduce myself. So I'm actually from the exchange world. I used to work for NYSE Life, the New York Stock Exchange, and prior to that, I was in Toronto, in Canada, actually working for the Montreal Exchange, which is part of the TMX group. And the reason I created Tradable Patterns really about 6 years back now was I noticed in the course of the many client visits I used to make to hedge funds, prop trading houses, and so forth, that a great number of the clients or those prospects who I used to visit were using technical analysis on a fairly, I'd say, very light manner, where in a lot of cases I just felt that there are a lot of nuances to technical analysis that a lot of these traders were perhaps missing out on. And so I thought, okay, well, let's create a business around the different asset classes I've been exposed to. So about 6 years back, I created a newsletter, basically a daily newsletter on futures and FX, and the crypto coverage is something that's been more recently introduced as of late 2018. So that takes me to where I am now. So today, what I'm going to cover will be a discussion around the hash rate and why it's something that we should all monitor, what the significance of it is, and what it really means, and how it impacts Bitcoin miners or miners of other coins, and what that means perhaps for price action for coins like Bitcoin. Then I'm going to talk about what we have observed in the past with the impact from stablecoin known as Tether. So it's a very widely used stablecoin, which I'll explain a little more on its role within the crypto ecosystem, but by no means is this a promotion of Tether. It's really more just to explain sort of why traders monitor for potential price impacts on Bitcoin from issuance of Tether. And then I'm going to talk about how Bitcoin has fared versus other top alts known as altcoins in long form. And so we have the ETH or Ethereum, which is our number 2 crypto market cap coin currently, and followed by XRP, which would be oftentimes just referred to as Ripple. And then I'll, of course, top things off with a discussion on technical analysis, where we'll talk about how the coin, how Bitcoin has been faring in the last, I would call it a medium-term time frame, with a focus on the monthly and weekly chart price action. So coming into the hash rate, a lot of people have been actually charting hash rates for a while. I'm not sure if you've all been hearing about sort of how it reflects on bit miner commitment towards mining. Basically, it reflects the amount of computing power, or hash power as it's often referred to, that these Bitcoin miners commit on producing Bitcoins. Okay, so throughout the mining process, what's really happening is, as James had alluded to earlier, there is a bit of a lottery process where all the different Bitcoin mining machines, they are vying to be awarded a block of rewards for their efforts in validating all the Bitcoin transactions. So in one block, you're looking at, it varies depending on the time that you inspect these blocks, but we're talking roughly 3,000, 3,500 transactions. Okay, so all those transactions have to be validated, and basically, once we have the lottery award determined by the algorithm of the blockchain behind Bitcoin, the winning Bitcoin miner ends up receiving a block of reward. So as James had mentioned, there's a block that has just halved. So it used to be a block amount of 12.5 Bitcoins, but that recently, May 11th, that has fallen down to 6.25. And just want to apologize just very quickly. There is some background noise. We're all working from home, so just thought I'd point that out. There's a bit of construction going on in my building. But yeah, basically back to the hash discussion. So quite oftentimes when looking at a chart of and I'll have this chart on a later slide, but when we're looking at a chart of how the performance of Bitcoin has fared on its price versus the hash rate, we'll oftentimes notice that there is a correlation of sorts that may provide price signaling benefits. Okay, so looking at this chart here, this table basically just shows you who the big producers of Bitcoin are insofar as mining output. And so China, as you can see right at the top there, accounts for about 2/3 of the world's production. And that's highly concentrated in the Sichuan region, as well as Inner Mongolia and Xinjiang in China. And there are all kinds of reasons for that. So typically miners will locate where you have cooler climates, so the machines basically can remain on the cool side so that they don't overheat. And of course, a miner needs to look at the cost of electricity. So with electricity costs being relatively lower in some of those regions of China, which I just mentioned, and in other parts of the world as well, due to perhaps high availability of hydroelectric power, where in a lot of instances there's surplus electricity that the local power plant needs to sell, and if there isn't that demand for it, in many cases very much warmly embracing the miners. Okay, so looking at this chart, this was the one I was actually alluding to a couple of slides earlier, where if you just look at how, and I'm just going to try to grab this tool here just to illustrate with this pencil tool what I'm referring to. So you'll notice how I've drawn circles just around where we've had massive rallies in the past. So just looking at, for instance, the second halving, which would have been in 2016. If you look at this rally here, this rally in the lighter blue line being the hash rate, we had a steady uptrend versus the price action. You'll see that. Sorry, my hand isn't the steadiest here, but basically what I'm trying to illustrate is we had in this area where I've circled here, we have an unusually strong rally, which in a lot of instances in these areas where I've circled, you can see where as soon as the price decisively, and once again, the dark blue line, as soon as it decisively ramped up above the hash rate, we saw a fair amount of upside in the subsequent period. Okay, so what you will notice though is that those subsequent ramp ups in price have become shorter in these recent circles, which I've highlighted. So if you look at this most recent one here, you'll see that we're just on the verge of beginning potentially one of those ramp ups. Now the question then, of course, and this is probably already obvious to most of you, is that we are seeing a leveling out in the curve. So this was of course pointed out by James as well, and so it's it's something that reflects a lot of things, but obviously the miners, they are very cognizant of the fact that their profitability with respect to the number of Bitcoins they receive per block is only half of what it was prior to May 11th. So there is that consideration from the miners. Obviously, there are offsets to keep miners motivated in producing Bitcoins. And, one of those incentives is as a part of the Bitcoin algorithm process, there's a factor known as difficulty. So the difficulty has fallen. And so that effectively makes it easier to produce the Bitcoin. So that's a bit of an offset. Keeping in mind as well, there's the transaction fees that come with each block that ends up being validated. So basically all the transaction fees that are associated with transferring the Bitcoins that are represented by that block that is validated, that all goes to that winning miner. Okay, so transaction fees have actually gone up in the recent past since the halving on May 11th. Okay, so on this chart here, what we're looking at is what the halving has done to Bitcoin Cash, and just to be clear, Bitcoin Cash is a fork of Bitcoin. So again, I'm not promoting Bitcoin Cash, but I'm just illustrating a recent example actually from this experience that Bitcoin Cash had around April 8th, and the dynamics around mining are very similar, whether we're referring to Bitcoin Cash or regular Bitcoin. So the point of this slide really is to have you just note that on the day of the halving, which I've highlighted with this orange circle, you can see that the hash rate fell, which is what we've observed with the regular Bitcoin as well, which you'll see on a later slide. But on this upper plot here, the chart up here, you can see the price action of Bitcoin Cash, and you can see that the price actually remained fairly stable. In fact, you might even argue that it sloped slightly up post-halving. Okay, now the other thing to observe is what halving on one coin could do to the price action or perhaps the hash rate on other coins, blockchains. And so with the May 11th Bitcoin, the original Bitcoin's halving, which you can see here, there actually was a rise in the hash rate dedicated to producing Bitcoin Cash. So what that just tells you is there's a bit of a rotation going on from some miners where when it becomes more profitable, relatively more profitable to mine a certain other coin, you're bound to get a rotation, and it's a purely economic decision from the perspective of the miner. And so looking here at another fork, this being the fork of Bitcoin Cash, known as Bitcoin SV, we do see that actually, once again, on the day of April 10th, the same day as the recent halving with Bitcoin Cash, we do have a substantial drop in the hash rate as you would expect for Bitcoin SV. But as with Bitcoin Cash, with Bitcoin SV, due to the original Bitcoin May 11th halving, we actually had a rise in the hash rate for Bitcoin SV. Okay, so once we look at a longer term chart of the hash rate, it becomes a little more evident how overall mining commitment has soared in the last, well, according to this chart, in the last 4 years or so. So it's been a very, very strong climb. And you can see, although with the third halving, which this presentation has been all about, we are still substantially in absolute terms, we are substantially higher, at roughly 100 exahashes in hash rate. Okay, now the all-time high recently, just leading up to the third halving, was roughly 140 exahashes. So that just gives you, and that's per second. Okay, that just gives you the average hash rate per day. Okay, now looking here at these pair of charts, we're now looking at the original Bitcoin. Okay, so this is a shorter time frame as well. This is about 3 months of price action on the upper plot and the hash rate on the lower. So on the lower plot here, you can see what happened May 11th. In fact, the hash rate was trending up, interestingly, in the couple months leading up to the May 12th, May 11th halving. Okay, so actually the key now, of course, is for us to understand, okay, so what's going to happen going forward, since this reflects Bitcoin miner confidence in the price of Bitcoin, in effect. Okay, so we have a bit of history subsequent to the May 11th event. This halving actually initially was expected for May 12th, but it came forward a bit, and the exact timing is never known in advance, just due to the way blocks can be mined a little faster at times or a little slower, depending on a variety of factors. Okay, so diving right into Tether, I mentioned earlier that there's a stable coin which perhaps some of you interacted with. It's a way for a lot of participants in the market to enter into the crypto ecosystem. It's oftentimes described as an on-ramp, and particularly in China, which, as I mentioned, accounts for maybe 2/3 of the hash power of the mining out there. A lot of those miners, they end up, obviously, with a lot of Bitcoins, they need to convert that somehow back into fiat. And oftentimes, there's this intermediary of Tether used. There are other stable coins as well. So I guess what's important to realize, though, is Tether daily volumes have actually exceeded Bitcoins overall. So it is a very highly used product, and that's not to be confused with market cap, right? The volume and the market cap are two separate things. But on the market cap, it is number 3. So it actually recently has exceeded Ripple, okay? So, or XRP. So it is something that a lot of people watch, just because of that on-ramp, off-ramp role that it plays in places like China, where those who want to participate in the market or exit the market, they're just not able to with US dollars. And so that's really, it should just be thought of as a substitute in those jurisdictions. Now, I just wanted to point out one other thing is, so a lot of traders will actually monitor for when Tether is issued, okay? Because on the following slide, you're going to see there is a bit of a correlation that some people will observe, where oftentimes when the Tether issuance happens, obviously the market cap grows, and so you oftentimes note that the Bitcoin price follows or may actually even lead that, if there's some advanced, let's call it notification or understanding that Tether is about to be issued. Okay, so that's an interesting phenomenon, and again, this is not a recommendation for buying Tether per se. It's just something to help you understand price action on Bitcoin. So looking at this next set of slides, we'll try to understand a little better how correlation between Bitcoin and Ethereum, or Ether, has performed over time. So being the number 2 crypto market in terms of market cap, Ethereum are very important to watch. And so what we're noting here on the lower plot of the screenshot is that correlation has been positive throughout this past year. But at times, you will notice that it does drop quite significantly, as we can see it almost went to 0 here. It never went to negative in this past year, but that's just something very interesting to note, where some people automatically assume, well, just because Bitcoin is rallying, Ethereum or Ether should as well. And so that's not always the case, right? Right now, in the recent past, last month or so, we are seeing a coming off on that correlation. Okay, so the question then becomes, okay, are we going to are we going to go all the way back down to a near zero type correlation situation? And with XRP or Ripple, that volatility in the correlation is more pronounced. So if you look at the correlation here, I would say late October last year and early August last year, where we actually had negative correlation, that's something that exists far more often with Ripple. And again, this is just a 1-year correlation chart, but Ripple really has a different role in the crypto ecosystem. For those who don't follow Ripple, it's been sort of competing in a lot of instances with the stablecoin concept, with projects like what JP Morgan's working on, et cetera. So it's carrying a different role. It's not seen as digital gold, store of value, or as even necessarily a speculative product. I mean, depending on who's trading it, obviously it's got its share of speculators. Okay, now going into technical analysis here, I just want to keep things high level. What we're looking at here is a 5-year monthly chart, and what I've highlighted really is the triangle pattern, and this is something that James had mentioned as well. Bitcoin's been in a massive triangle for a while. So the question then is, well, do we break to the upside of the triangle or to the downside? And oftentimes it's prudent to wait until the breakout, whether it be to the upside or downside of a triangle, before taking a decisive position, either direction. Okay, so looking at the momentum indicators in the lower plot here with the MACD, what we're seeing is an attempt to positively cross. So that is generally, when just looked at in isolation, that is a bullish signal. But as those of you who follow my newsletter would know, there generally is a multiple indicator approach that I take, where I prefer to see confirmation across many different technical signals, technical indicators, before jumping in either way. Now, when we change the chart's candlestick time frame from the monthly to the weekly, but still viewing a 5-year time frame on this screenshot, things look a little different. So we can see, I guess, a little more granularity on the candlestick action, where here on this recent, call it 4 months since Feb, we can see that Bitcoin actually had a notable fake out. If we were to have been a big believer in the bear signals that come out of breaks below triangle supports, which we saw in this sort of maximum selling period in around mid-March, that would have perhaps caused people to even enter shorts at the time, and let alone dumping their longs. And so that ended up being a massive fake out, since that low of roughly 3,900, below 4,000, we've soared all the way back to roughly 10,000. So it's quite remarkable. And of course, now we're getting the same kind of question, where we have the price protruding just above triangle resistance. So the question now is, okay, is this going to be another fake out where fresh longs get established only to get washed out on another sort of reversal? So just keep that in mind. I mean, looking at the weekly RSI, stochastics, and MACD, they are sloping upwards generally. So on the surface, it looks fairly bullish, at least on those counts. Now, when we go into the shorter term 1-year daily chart, we do see that on this more sort of micro level, we're able to see the break above, particularly just in the last month or so, above this downtrending resistance line, which has held for about a year. Okay, so this downward resistance line is really just another one of those major zones of price action that we should be monitoring closely. Obviously, here on the RSI, stochastics, and MACD, you can see that there was a bit of conflicting signals coming in, where where by virtue of being in the overbought region, at least for the daily RSI and stochastics, one can argue just when looking at those two indicators in isolation that perhaps we're going to get a bit of downward action from here. Okay, so looking at these next few slides, we have screenshots from, well, this first one's from the ICUS Bitcoin futures market, so the physically deliverable contract. And so what we're looking at is the June contract and a daily chart. And on this next slide, we have the 4-hour chart of the same contract. And this one here just gives you a view of how things can be perhaps arbitraged, across those two contracts, the ICUS versus the ICE Singapore, by looking at any discrepancies between the price action across the slides I just showed you and this one here, along with this one. Okay, so keeping in mind this is a continuation chart. Okay, this is the 4-hour. Now looking at this slide here, we have the cash out May contract. Okay, so this is the daily, and this would be the 4-hour. And that's how you can all get a hold of me. If you have any questions, feel free to write me or WhatsApp me. Hopefully, today's session has been very informative, and looking forward to speaking to you all again soon. Thank you.